We're looking at exploring tax, types of taxes and charges. So taxes can only be collected if a law has been passed to permit their collection. The Commonwealth of Australia Constitution Act established a federal system of government when it created the nation of Australia in 1901. So it was all created in 1901. It distributes lawmaking powers between the national government and the states and the territories. Each level of government imposes different types of taxes and charges. During World War II, the Australian government took over all responsibilities for income tax and has remained the major source of federal tax revenue ever since. These are the levels of government, and so you've got the federal. They look after income tax, Medicare, company tax, goods, services, fringe benefits, tax, capital gains tax, customs duty on imports, excise on fuels, departure tax at the airports, petroleum resource rent tax, and special purpose levies. Your actual state or territory does your payroll tax, your stamp duty, your land tax, special purpose levies, and taxes on gambling. So all of these will be the same no matter where you are in Australia. These will be different depending on where you are in the state. And then local would be the Fraser Coast, for instance. So your property rates, your rubbish disposal charges, your building permits, fines, and animal licenses for pets. Tax information is recorded on a wide variety of documents. For example, your pay slip from work, which will show how much income tax has been deducted from your pay. A sales invoice from a clothing store, which includes GST, general sales tax. A rate notice for your family home, and an invoice or receipt for a sale of a motor vehicle. Registration receipt. There are three tax structures used in Australia. You've got your proportional taxes. So these are the same percentage it's levied regardless of the level of income. The company tax is a proportional tax, and as the same rate applies for all companies regardless of the profit earned. So if they make so much, they pay a percentage. That's it. Progressive taxes is the higher the income, the higher the percentage of tax paid. So basically, the more you earn, the more you end up paying. Income tax for individuals is a progressive tax. So what we pay on our salaries is progressive tax. And then you get a regressive tax. This is the same dollar amount of taxes paid, regardless of the level of income. So the departure levy on passengers at airports are regressive. So if you're going all the way around the world, you pay the same tax as if somebody who's just going to Brisbane. Some community organisations are exempt from paying income tax, and some low-income individuals do not have to pay tax. Some people argue that regressive taxes are unfair. That's the one that's the same no matter what, because they charge the same amount, whatever a person's income or capacity to pay. Other people argue that this is not necessarily so, because a regressive tax may be levied on an item bought only by wealthier taxpayers. This is the case, they say, with the luxury tax on more expensive vehicles. Some taxes discourage consumption of specific goods or services. For example, taxes on tobacco, which is very high, and alcohol. Fuel taxes are designed to encourage people to use fuel-efficient vehicles and equipment. So they put the tax on so that you can try and think of better ways, travel together to work, things like that, so you save on fuel. Other taxes ensure people contribute towards government services, such as collecting the garbage, maintaining the roads, and enforcing the speed limits, okay? So that pays for all of that. When considering a tax, an important decision has to be made as to whether the type of the tax will be proportional, progressive, or regressive. Now I would like you to work together to complete activity 1. Right, once you've done activity 1, so pause me until you've done activity 1, we're going to talk about income tax. Individuals may be responsible by law for a range of personal taxes. These taxes can be imposed on income that is earned, purchasing goods or services, selling assets that are liable for capital gains tax, and other transactions. You have a legal responsibility to know what taxes you are liable to pay. You can't say, I didn't know I had to pay tax on it. The Australian income tax system relies on taxpayers self-assessing, which means you are responsible for working out how much you need to declare and can claim on your tax return. You provide this information to the Australian Taxation Office, which is the ATO, which then calculates how much income tax you must pay. What is assessable income? Assessable income is income tax on which tax must be paid, and income on which tax must be paid. Some examples of this is wages and salaries, bonuses, and commission received as employment income. Income support payments from the government, such as age pensions, family, youth allowances. You all pay tax on that. Money received from property or investments, for example, rent earned from leasing a property or other items. Interest from assets, such as bank deposits or bonds. Dividends earned from ownership of shares in a company, so wherever you make money. A capital gain on the sale of a capital gains tax asset for more than you paid for it. What is not assessable? Not all money received by an individual is considered to be assessable. Examples are pocket money, yay, inheritances, lottery or prize winnings, so you don't have to pay any tax on them.